Big Tech just fired 300,000 workers in a single coordinated move. Microsoft, Google, and Amazon executed the largest workforce reduction in technology history. But this is not a recession. This is not panic. This is the most calculated capital reallocation Wall Street has seen in 20 years. These companies are trading human salaries for something far more valuable in 2026: AI data center infrastructure. And the numbers behind this shift reveal exactly where institutional money is flowing right now. Let me show you the macro data that retail investors are completely missing. Between January and March 2026, tech giants announced a combined $350 billion in AI infrastructure spending. That number is not speculative venture capital. That is committed capital expenditure for physical data centers, GPU clusters, and energy infrastructure. To put that in perspective, the entire US federal infrastructure bill passed in 2021 was $1.2 trillion spread over 10 years. Big Tech is deploying nearly 1/3 of that amount in a single year, entirely focused on AI compute capacity. Now here's where it gets interesting. The average fully loaded cost of a tech employee, including salary, benefits, and real estate, is approximately $250,000 per year. 300,000 layoffs equals $75 billion in annual cost savings. That is not enough to fund a $350 billion infrastructure build-out. So where is the rest of the capital coming from? Free cash flow and debt markets. In the first quarter of 2026, investment-grade corporate bond issuance from tech companies hit a record $89 billion. That is a 340% increase compared to the same period in 2023. Smart money is lending to big tech at historically low spreads because the market believes AI infrastructure is the new oil. And institutional investors are not betting on software margins anymore. They are betting on who controls the physical computational layer. This is an infrastructure arms race disguised as a tech cycle. Now let me translate this into actionable positioning. If you want to track where institutional money is actually flowing, you need to stop looking at software stocks and start looking at 3 specific infrastructure plays. First, the Global X Data Center, REITs, and Digital Infrastructure ETF, ticker VPN. This fund holds the physical real estate that houses AI data centers. Year to date through April 2026, VPN is up 34%, while the NASDAQ is only up 8%. Why? Because smart money knows that whoever owns the land and power infrastructure owns the AI economy. Second, the VanEck Semiconductor ETF, ticker SMH. This is not a new play, but the composition has shifted dramatically. As of April 2020, SMH has rotated 23% of its holdings toward companies that produce high bandwidth memory and networking chips, not just GPUs. Institutional allocators are betting that the bottleneck in AI infrastructure is not compute anymore. It is data throughput. Third, and this is the contrarian play, the Invesco Water Resources ETF, ticker PHO. You heard that right. Water. AI data centers consume approximately 5 million gallons of water per day for cooling. A $350 billion infrastructure build-out means unprecedented demand for industrial water infrastructure. PHO is up 19% year to date, and most retail investors have no idea why. Now let me give you the historical context that makes this move inevitable. In 1999, during the dot-com bubble, telecom companies spent over $100 billion laying fiber optic cable across the United States. Most of those companies went bankrupt by 2002, but the infrastructure they built became the foundation for every internet company that followed. Google, Amazon, Netflix, none of them would exist without that 1999 build-out. The investors who bought the telecom companies lost everything, but the investors who bought the real estate, the data centers, and the infrastructure plays made generational wealth. We are watching the exact same pattern play out in 2026, except this time, the infrastructure is not fiber optic cable. It is GPU clusters, liquid cooling systems, and dedicated power grids. And here's the critical difference. In 1999, the infrastructure was built speculatively, hoping demand would follow. In 2026, the demand already exists. ChatGPT reached 100 million users in 2 months. Every Fortune 500 company is deploying AI agents. The compute demand is real, measurable, and growing exponentially. So when you see headlines about 300,000 layoffs, do not read it as a contraction. Read it as a reallocation. Big tech is not shrinking. It is shifting capital from labor to infrastructure because the ROI on AI compute is higher than the ROI on human employees. That is not a moral statement. That is a financial reality that institutional investors have already priced in. And if you are not positioned in the infrastructure layer, you are on the wrong side of the biggest capital shift since the internet itself. The playbook is clear. Follow the data centers. Follow the semiconductors. Follow the water. That is where smart money is moving in 2026. This analysis is for educational purposes only and does not constitute financial advice. All investments carry risk, and you should consult a licensed financial advisor before making any portfolio decisions.